Welcome to the Mortgage Guy Podcast with your host, Darian Newlick, where I will educate you on mortgages and real estate done right. Hello, everyone. Welcome back to the Mortgage Guy Podcast. Again, this is your host, Darian Newlick. Pleasure to have you all back again for a new episode. And today we get to talk about VA loans for all you veterans out there, to be able to go over what you need to do to qualify for a VA loan. And what we do here in this first series that we have is we're going straight to the guidelines. And we're going to go over the key common areas that essentially I or any loan officer will review or see on a routine basis. There are certainly outside factors, but I can't stress enough, I can't go over everything. Otherwise, this would be hours and hours of a podcast that would be very tough listening to. So again, welcome back. Again, just want to give a shout out to my partners with Lululemon being able to partner with us. And we are so thankful that these shirts that we have are absolutely phenomenal. I'm actually wearing one of their men's polos. So if you are a male who's in the workforce and you are looking for something that's a little bit lighter, something that feels very nice, not just on your skin, but also easy to wash and easy to hang up, wear a couple times in a row. These are phenomenal shirts to wear, as well as I've got their shorts on as well. So definitely highly recommend wearing Lululemon. I do have links to be able to buy Lululemon if you are interested on various places on my social media. And also we'll drop one in the link or in the information below on this podcast on my YouTube channel. So we're going to dig in right here into VA loans. So if you look on my screen on the YouTube channel where I'm at, so very simple, I'm in the VA handbook. You can feel free to type in this address. You can just go to Google, just type in VA handbook, look for this. The VA doesn't give a straight up handbook like all the like FHA and conventional that we have reviewed before. They have condensed it onto their online site, which is pretty nice. So we get to go kind of like which chapters here are the ones that we're really going to go over. So the main one that we're going to be in, though, is in this credit underwriting one here, and that says new. So that's the one we're going to stay in because it is new. They have revised it. So there's always updated, being able to revise their guideline or their handbook every year. There's certain sections that they'll update every year, not necessarily all of them. So that's why you see a bunch of new sections here. And like this one, they have the old section still there. Before we get into that, we're just going to go a little bit into veterans eligibility and entitlement. So if you look at my screen, it has me downloading the Word document. So some of these aren't Word documents, some of these are in PDF. So we're just going to go kind of right on in. It doesn't look like there's a ton of pages here, but at the same time, I just want you to understand a little bit about VA entitlement and how that works. So here's a key thing. So it's the certificate of eligibility. So if you are a veteran, you need to have a certificate of eligibility to be able to purchase a home, and you have to be eligible. Okay, so you can get a certificate of eligibility for just being a veteran, but you may not qualify for a VA loan. It depends on the service time that you've had. If you have been active duty, technically if you've been discharged for like medical reasons or anything like that, 9 times out of 10 you could meet the requirements to be able to be eligible. But there's some times that you will have a great one is like reserves. So if you're in the reserves and you have like 2 years of reserve experience, you're not going to be eligible for a VA loan. So just keep that in mind. You need to get your certificate of eligibility. A lender can actually pull that up. They have there's a tool that they get to utilize where they can just honestly in their online system and just pull it up. Otherwise, you can go ahead and I would call your regional office for the VA. You can easily go to, so if you look at my screen and I went to Google and I did VA regional loan office or office and regional loan center contact information, and this gives you all the regions. So there's Atlanta, that's what they cover, Cleveland, they cover a lot, Denver, Houston, Phoenix, Roanoke, so Virginia, St. Paul, Minnesota, and then St. Petersburg as well. So those are the regional loan offices that you would go to and be able to see if you are eligible and if you can get a certificate of eligibility. So there is that. If I go on, so actually one key thing, so funding fee, veteran is not exempt from funding fee due to non-service connected pension. Loan application will require prior approval by approval processing by VA. So the funding fee, just so you're aware with the VA loan, FHA loans have them, VA loans, and USDA loans. So this is all under Ginnie Mae. So there's conventional, Freddie Mac, Fannie Mae, and then there's Ginnie Mae, which is FHA, VA, USDA. So the funding fee, this is high risk based insurance, okay? So the VA doesn't require that you have a monthly mortgage insurance like FHA or USDA, but they do require that you have this upfront premium that you do not bring to close. It just gets put on top of your loan amount for your new loan amount. So let's say, like with the VA, you can do 100% financing. So let's say your purchase price was $100,000, you are financing $100,000, so you're bringing zero down payment plus your closing costs. Your loan amount would be $100,000 plus this funding fee that's put on top of it, and that's your new loan amount. Okay, so that's how, like, if there is a loan limit for an area, it's based on the base loan amount, not on this added funding fee that goes on top of it. So keep that in mind. So so what they have here is they say it's not exempt from funding fee due to non-service connected pension. But if you have VA disability, that is what predicates if you are exempt or not. Those are the only veterans that I have seen ever be exempt from a funding fee. If you have VA disability to some degree. I don't know if there is a specific dollar amount tied to that. But I have seen them as low as, there's people who get $100 a month with VA disability that have gotten the funding fee completely waived. So it just depends. But there are different levels of funding fees. So just scrolling down here, that's really the biggest area that I wanted to touch on because that's the most common. Let's see here, anything else? Again, funding fee, funding fee, funding fee. That's really the only key thing that's really being talked about in here, how to apply. Okay, so we're gonna get out of here. That's really just talking about the COE. So that's just really key that I want you guys to know when it comes to actually applying and getting approved. That's the first thing. You need to be eligible from that standpoint. So we're gonna go on here. So look at that, 2 of 72 pages, not 1,954. So this would be a little bit faster for us compared to the other episodes. So going on through here, so credit underwriting information, blah, blah, blah. We're getting through that. So far, nothing crazy. These are all just nothing key there. You see here, IRRL. Okay, there we go. So it's called an IRRL. That's the mortgage term. Just call it an IRRL. So you'll see that a lot in this handbook. You'll probably see it very frequently. So basically, just like FHA has a FHA streamlined product, so it's a refinance product. That's what an IRRL is. It's the VA's version of that streamline. There is no appraisal required. What typically happens is a lender has to eat a portion of fees because your loan amount can only be whatever that loan amount is, plus certain fees can be added to it. Okay, so your payoff. So if your payoff is $100,000, the lender can only put as the loan amount $100,000 plus certain items can be rolled into that. And then you have to bring the difference to close. But there is a threshold on what you can bring to close, and the lender has to eat the rest of it. So a lender or bank, when they do a streamline, they don't make as much money because they have to eat a portion of those costs with you. So you're not really rolling in a bunch of costs into that loan, whether it's a FHA, VA, or USDA streamline loan. It has to be like you have to have bought the home FHA, or your prior loan was FHA, or prior loan was VA or USDA, and you're refinancing with that same product. That's the only way that works. So you can't do an FHA loan and then do a VA IRRRL. It has to be a VA first, and then it stays with VA, and you're just lowering your interest rate at least 0.5%. And it is probably the lowest cost loan because, again, a lender has to eat actually a portion of that, but you do have to have funds to bring to close. I just tell everyone, expect to bring about 2 payments to close. That's usually where the threshold is, as far as what you can bring. So you can't just a lender can't just go ahead and say, okay, here's the loan. We're going to reduce here's your payoff. Here's the loan amount. We get to add this $1,000 into it, and then we're going to require you to bring $5,000 to closing. It doesn't work like that. It's got to be, and I'm just using a $100,000 loan amount, for example. It would be like, okay, now you have to bring $1,600 to closing. The lender has to actually eat that difference, and then they sell that in the secondary market, and then they return a profit that way. So that's a little bit of insider information on how that works. Okay, so income. So income is generally the same as FHA. One key thing that's different with income here is with the VA disability income that is shown on your certificate of eligibility. That automatically gets counted. Some lenders will want to see, or banks will want to see, the actual incoming amount into your bank account. But the minute it gets put onto a COE, that's already the verification. You're good. So that's all a lender needs for VA disability income if you're doing a VA loan. Everything else is pretty much the same in regards to like W-2 income. If it's just a standard salary, you need your most recent pay stub, the last 2 years of W-2s. Bam. If you have hourly income and it's set like 36 hours a week every week, or like you have a minimum amount of hours you have to work, so 36, 40, 32 are the 3 most common, and you make $40 an hour, most recent pay stub, last 2 years of W-2s. If you have variable income, it's the same stuff, but you're taking an average of that income. Overtime is going to be an average of 2 years of income, just like variable hours. Okay, so 2 years. All that stuff applies. You're self-employed. I need 2 years of tax returns. Bonus income, commission income. If you have overtime income. 2-year average is what a lender will use, but if you have at least, I would say, a year, depending on if it's going to continue. So if it's like a strong part of your job and you make commission income, for example, or you make bonuses every month, then that income is likely going to continue. So on a verification of employment, the lender just wants the employer to address that income is going to continue. So at least 1 year, but ideally, again, you want to see about 1.5 years of that. So I would wait personally until you have 1.5 years of that income before you try to apply. If you have a certain situation you need to apply now, I get it. Lenders are there to work with you, but it's a little bit harder to get done. Still doable though. I've done it a bunch of times myself, so it's not something that's unseen. It's just more favorable with at least 1.5 years. 2 years of job time, all the same stuff. So I'm not going to get too involved here. With again, FHA, USDA, and VA have very similar guidelines when it comes to that. So I don't want to get too in depth on the income here. It's all generally the same. So let's not go too crazy. I want to get more into the credit stuff because that's the stuff that's going to count the most for this. So let's keep on going down. All the required documentations, it's all going to be the same. If you have rental income, I still need tax returns. There's nothing I could do. All the same. So just more income. I want to get to credit. Let's go to credit. Taxes, other deductions, no. Assets. Asset documents are all going to be the same. So now this is on assets. So assets, you have, again, same as pretty much the other products. A lot of these guidelines don't really change much, especially, like I said, FHA, VA, USDA. You'll hear me say that a million times in this. But even Fannie and Freddie have very similar guidelines to this. You know, you have, you're pulling money from a retirement. You need the most recent statement. So usually they're quarterly, sometimes they're monthly. You go pull that up. You get the terms of withdrawal when you withdraw it. You go ahead, you have to show that the money left the 401k and it entered the new 401k. It entered your bank account, not the new 401k, your bank account. So that's how that works. There are some 401k companies that will wire funds to a title company, but it's very rare. I've seen it happen only one time. So I would just say they're gonna wire it to your bank account. Checking, savings. 2 months most recent statements. Conventional is typically 1 month. It depends on what the finding state for conventional, whereas FHA, VA, USD are all hard stop on 2 months minimum. So making sure you have those 2 months. And keep in mind, if you carry over, so that doesn't mean you submit 2 months and you're done. Same thing with income. As time goes on through that process, you'll need an updated pay stub. You'll need an updated bank statement. Once you carry over into new months, you'll need a transaction history. Transaction histories are from the day after the last day of the statement. So if it ended on the 30th of a month, of a 30-day month, then you'd get from the first to, we'll call it, today's the 26th of this month is when you would get the transaction history, just to show you still have those funds in there, because the lender knows you don't have another statement. So just keep that in mind. What else is common? It's usually checking, savings, retirement, mutual funds, investments. Usually the most recent statement will suffice, because those vary. Those could be quarterly, those could be monthly. Most investment will be 1 month though, for the most part. All real simple. The gifts are all the same. So if it has to be a family member, or it can be like a really, really close friend who we can prove that you have a strong relationship over years, and we have to somehow prove that and accept that, which has been done. If you are dating, if you are partners, we have done that before. There's a lot of lenders who will use that. So it just depends on the situation. Most people are getting money from family. So I would just kind of stick in that realm. But if you need another source, just review that with the lender. So debts and obligations. I mean, one thing with FHA, VA, USDA, so Ginnie Mae, is there's a CAVERS. What do I say? So it's called CAVERS, and it's the system where if you owe federal debt, it gets put onto this system. Generally, there's two main items. The first one is going to be if you have defaulted on student loan debt, and the second one is going to be if you have defaulted on a FHA, VA, or USDA loan. So those are the only two that I generally see. So if you owe money, we'll call it on the student loan debt, you have two options. One, you could pay it in full, or you can go onto a payment plan, and I believe it's 3 months, and then they will take it off of CAVERS. The mortgage company, all they need is they need it taken off of CAVERS, but they will apply that monthly payment to your debt to income ratio, just so you know. So if it's $300 a month, that $300 a month goes into your expenses, okay? So, because they know you owe that debt and you're paying on it. It's not something that is paid off. So that is information that they're going to have. That can fall under the manual underwriting requirements of additional information that is not revealed on the credit report. So that could cause, based on the file, so if you're like an 800 credit score and you have this debt, it probably won't be a manual underwrite. If you have a 620 or a 630 or a 605, you're probably getting converted to a manual underwrite. Typically, there's some other things probably on the credit. So it just depends on the file. I'm just giving you like the most clear, realistic reading of that from an underwriting perspective. So other debts and obligations, nothing really there that's different. If married veteran wants to obtain a loan. Okay, so actually here's actually something really cool. If a married veteran wants to obtain the loan in his or her name only, the veteran may do so without regard to the spouse's debts and obligations in a non-community property state. So just keep in mind, if you're the veteran, you're not considering your spousal debt. It's not household debt. USDA is household debt. Other programs are not household debt. So this is saying that, hey, you don't need to consider the household debt of your household, your family. Now, one thing that a lot of people don't know is that if you are a widow of a veteran, or your spouse has passed away and that your spouse was a veteran, in most cases, you have a one-time VA eligibility, which means you can get a certificate of eligibility to use one single time only. So if you are someone who was married and your spouse passed away while you were married, so not, hey, I was married, we got divorced, and then they passed away. Doesn't work. They have to be married. That spouse passes away, the veteran does. You should reach out to the VA to see if you qualify for the one-time use. And that would really put you in a position to get a really, really good loan with no mortgage insurance for not a lot of money down, or at least less than 20%. Because most people today are not putting down 20%. Most people are putting down, that I'm seeing, are somewhere in the 3 to 10 range. It's a lot harder with inflation that we're finding, where people are putting down less money because home values are going up, which means that they have to put more money down, and it's harder to save as cost of goods go up. So a lot of these programs eventually, I would imagine, are going to have some sort of curtailment to that. As these inflation rates considerably go up and they find it's harder and harder to be able to put more money down. So just as of right now, again, it's a great option, no mortgage insurance. If you do that, you would just have your VA funding fee, which again depends on the situation. There's different levels of funding fee. Okay, so written evidence of student loan. So student loan debt. One thing really, really cool about student loan debt, so as you know, as I told you with FHA, they dropped their student loan requirement as far as calculating a payment on a deferred student loan or a student loan in forbearance. They dropped it from 1% down to 0.5%. And you could use 0.5%, or you could use a documented payment agreement that states what your payment is, and it has to be fully amortized. So we have to have proof that it's going to be paid off in full at that payment in 10, 20, 15, 30 years, whatever it is. The 0.5% is already generally going to be whatever that payment is, or at least really close to it. So now people do not need to really mess with trying to get that documentation or going on to that plan, which used to be something that a lot of people had to do. Now they don't need to incur that debt right away, get into the home and use 0.5%. And that's, Freddie has always been 0.5%. A lot of lenders don't know that. I've gotten a lot of loans done like that. And Fannie allows you to use income-driven repayment plan or the payment reported on the credit report. So if there is like a $20 payment on the credit report, bam, you get to use $20. And then if there is nothing on there, you're not on income driven, and you don't get yourself onto income driven, it's 1%. So they give you options to try to avoid putting in a payment. VA says we're going to take that loan balance and we're going to divide it by 12 months, and then we're going to so if the borrower provides written evidence of the student loan deferred in 12 months, closing does not need to be considered. So first thing is, if there's written evidence that the student loan debt will be deferred at least 12 months beyond the closing date. That's tough to get. So even in COVID, it was like 6 months. And then we go 3 or 4 months, and then, here's another 6 months. Okay, well, now we're still less than 12. So it's tough. But if you are a student, so let's say you're in graduate school, this is what that's more referring to. I'm in graduate school. I'm not going to have to repay the loan until I graduate. Well, then that would be at least, in that case, we'll say that they have 2 years. They can probably get something that says that they won't have to pay for another 2 years or while they're in school. So there's that. If the student loan is in repayment or scheduled to begin within 12 months from the date of VA loan closing, the lender must consider the anticipated monthly payment obligation in the loan analysis and utilize the payment established by calculating each loan at the rate of 5% of the outstanding balance divided by 12. There you go. Okay, so we're taking the balance and multiplying it by 5%. There you go. And then we divide it by 12. That is less than 0.5%. So that is actually the lowest student loan calculation outside of Fannie's income-driven repayment plan that you can get. So this actually puts it somewhere probably around 0.375%, maybe 0.4, but it's in that general ballpark of where that payment's going to be. So the VA gives you a lot of relief when it comes to student loan debt because they really want to help you out. So another key area, so you can get, if you're a veteran, you can get qualified for way more money and way less money down without mortgage insurance, and it's a much better loan than any other product out there if you're putting down less than 20%. If you want to do a VA loan and put down 20%, you need to weigh your option. If you're going to have a funding fee and you don't qualify to have it exempt, you're probably going to want to go conventional. If you do have an exempt funding fee, they tend to be about the same. So it's kind of up to you. I would say VA tends to be a little bit slower because you want to think government, but at the same time, VA is a very solid loan. Also, a lot of buyers are wanting to accept conventional because of the name conventional has established for itself. And so you may have more success with a conventional loan as an offer versus a VA. But if you're putting down less than 20%, if it was me and you're a veteran, I would do a VA loan 100% of the time, all day. So just keep that in mind. All right. Nope, that's fine. Use the current balance times 60%. So with Ginnie Mae, FHA, VA, USDA, you get, so your 401k, your retirement, if you can use it, only if it's if you can take a hardship out, a hardship loan or withdraw from it. There has to be some ability to withdraw from funds to use a retirement account or investment. If you can't use it. A lot of people don't know that. So you can't just say, I've got a retirement. Let's say you work for the school, like a school system, or a police department, and you have this retirement, and it's nice and stashed away, blah, 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 but you can't pull from it for hardship or you can't withdraw it for any reason. You actually cannot use those funds because they're not accessible to you until you leave the force or until you retire, until X age. So because of that, they are not allowed to be used with the loan analysis. So you have to have some withdraw function tied to it for you to be able to use it. Now, whatever is going to be in there, let's say you're drawing from your 401k or this investment or whatever it is, you're going to draw from that for your down payment. Well, guess what? That down payment is going to come out, and then that balance, you take 60% of that, and that's what you can use. Whatever the balance is, let's say you don't touch it, it's 60% is whatever you can use of your vested balance. So if you are vested 50% and you have let's say you have, I don't know, 100 grand, your vested balance at 50% is $50,000. So if it's $50,000 and this other 50% is from the company, you would take $50,000 times 60%. That's your new amount that you get to use as reserves and things like that. So from the standpoint of like qualifying, it's just more of a reserve thing. But if you're using that and that those are your funds and you're limited on cash, just know that you're going to have a reduced amount of what you can use, because they ideally say you're going to have expenses that are taken out of that. Okay. Now it can be increased based on if it's pre-tax or if it's post-tax. There are other factors tied to that. So I would go ahead and when you go to apply for the loan, this isn't the section right here, but I wanted to address it. When you go to apply for a loan and you are using your 401k, make sure that you go over if it's pre-tax, post-tax, all that stuff. And that way the lender, if you even need it, like if you're super tight on assets with what you're bringing down in your reserves, like let them know that and let them know, hey, you can take a higher portion. It's not 60%. It's higher. I think it's somewhere upwards of 75 to 80. And I think there are potentially up to 100% of it. You just have to ask the lender at that point in time. Okay. Debts owed to the federal government. So that was from Cavers that I was explaining. So if you owe debts to the federal government, such as you're in default on a student loan debt, then you need to have it satisfied. There's the Cavers. Okay, bam, Cavers is a Department of Housing and Urban Development maintained computer information system. So it is a system. There you go. So that's how that works. So you need to get, if it's on Cavers, it needs to be cleared off Cavers. There's no exception. Zero exception to that. Let's scroll down here. Credit history. So just know VA has the same requirements as FHA when it comes to credit. So there are programs down to 500. As of right now, still with COVID, I don't think anyone's released beyond 580 at this point. The 580 program doesn't allow you to do 100%. I believe it's 90. But again, I just want you to know it's not 100. Also, you have to have a very clean credit history. It has to be, for some reason, like past accounts have weighed you down. And essentially the reason why you're at a 580 is because you were originally at a 480. Your credit was so bad that you've improved it over time. Now you're, a year or two later, it's improved to a 580. You've done a great job. All right, now we can do a loan as long as you have the money to put down or increase your credit to put less down. So just keep that in mind. All the same kind of criteria as FHA for the most part. So I'm just going down through here. Collection accounts. So like FHA, if you have a collection account, you would be able to, if you don't want to pay it off, because if you have more than a $2,000 balance collectively in collection debt, you have to pay it all off or put 5% in of the balances as the payment, and you don't need any documentation. So here, with VA, I believe it's a little bit different. Isolated collection accounts do not necessarily have to be paid off as a condition. Credit report may show numerous satisfactory accounts and one or two unpaid medical collections. So medical collections are ignored all of Ginnie Mae, so you don't have to worry about that. In such instances, while it would be preferable if collections paid, it would not be necessary. It would not be necessary for approval. Collection accounts must be considered though, so they weigh you down. As far as your overall risk. History of collection accounts should have reestablished satisfactory credit in order to be considered as a satisfactory risk. VA does not require collections to be paid off prior to closing if the borrower's overall risk is accessible or overall credit's accessible. The underwriter must address existence of collection accounts with an explanation. If the collection accounts is listed, or if the collection account listed on the credit report with a minimum payment, then the debt should be recognized as or at that minimum payment amount. So they're not saying that you need to put in a 5%. They're saying it's based on the evaluation, and if there is a payment in there, you need to leave it. So here's the problem. When you have a collection account, so here's actually the downside to VA. If you have collection accounts, and let's say one of them's $400, sometimes on credit, they'll actually report that same balance as your payment and a past due payment. So if that $400 collection or $1,400 collection, whatever, has a $400 or a $1,400 payment, you need to pay it off because you don't want to have that as part of your debt to income. The tendency is with a VA loan, a lot of people, it's a little bit not as great on the income level as most conventional clients that I've come across. So if you're utilizing those guidelines of higher debt to income ratios, well, we need to make sure that we're not including $400 payments for collection accounts or $1,400 or whatever it may be. So you want to avoid that at all costs possible. You would have to get that paid prior to closing. I'll just keep that in mind. Charge-off accounts, they're not considered. They're considered in your overall credit risk when we run it through the AUS system. Okay, so when we run it through, it's called DU. So that's where you run a VA loan through. So when you run that VA loan, if it's approved, it's approved. If it's not approved, you have to look at the list from the manual underwriting standpoint. So those charge-offs do go into that risk, and that's where the underwriter will evaluate it. If you have an approved eligible though, you should be fine. So I wouldn't be too worried about the charge-offs. No lender's going to make you pay those charge-offs off, considering that they are charged off. They're written off the P&L of the current holder of that note. Disputed accounts, lender may consider a veteran's claim. So what I would just say for disputed accounts, for all of Ginnie Mae, if you have a lot of disputed accounts and you have strong balances, most lenders are going to want those disputes removed. And the reason being is because it's not giving your true credit score. Okay, it's not like, okay, so if you're at a 680 and you have 6 disputed accounts that all have derogatory marks on them, a lender's going to say, okay, well, we want these disputes removed because we want to see what your credit score will actually be or what it actually is. And so that's a key part. Your credit will probably drop down and go to the real score that it's going to be. There are certain caveats, like if you have 1 and it's something minor, if there's no late payments on it, or the lates are over 2 years old, I would think kind of FHA in that realm, then you're going to be fine. But if it's, again, a significant amount that's being ignored, what's happening is the credit bureau is saying, okay, here's a 680 because I'm ignoring these accounts. These aren't even being factored when they're disputed into your credit model. And that's how we generate X score. So when you add those back in, it's now saying, okay, bam, this collection is going to bring it down. This disputed account, this brings it down. So you have to understand a little bit about how those how the collection accounts work, so that the disputed accounts work, so that if you go to apply, you can go ahead and remove those disputes before you apply. I would strongly recommend doing that. Judgments paid in full or subject to repayment plan with a history of timely payments. A history of timely payments would be generally considered as making 12 payments to reestablish credit. So it looks like here from a judgment standpoint, they are looking for 12 months. So if you have a debt with, we'll call it a state tax lien, they're going to want to see 12 timely payments of that account. So just keep that in mind as well. I'm saying that a lot in this one. Keep that in mind. Keep that in mind. Okay, credit counseling. You don't need credit counseling for the loan. Bankruptcy. So bankruptcy, if it's, look over here, bankruptcy was discharged 2 years. So this is Chapter 7. It's 2 years. If it's within 1 to 2 years, probably not possible because you need extenuating circumstances. Extenuating circumstances are so hard to prove because a lender cannot voluntarily ask you for medical records. It's completely illegal. So on a voluntary basis, if you want to prove otherwise that there were extenuating circumstances as a client, you can do that. Okay? So that is totally up to you. Whatever you want to do. I'm just letting you know extenuating circumstances, it's up to you to prove to the lender otherwise. That's just how it is. A lender wants to believe you, they want to help you, but you need to prove it to them. They cannot legally ask you for any of that information. You have to just be willing to provide it. And if you were in a situation and that lender said, okay, it's 2 years from your Chapter 7, but let's say you actually had some major surgery that took place, and that surgery caused you to not work for a year. Well, you can go ahead and you could say, hey, I had this surgery and this caused me not to work. It was a serious, whatever it was, and I was not able to work for 12 months. Hence, this happened, blah, blah, blah. And you wanted to provide that information to the lender, then at that point, you could probably put yourself in a position for the extenuating circumstance to work for you in this 1 to 2 year range. But if you want to wait the 2 years is going to be the general rule of thumb. A lender cannot just take your word for it. And that's a lot of people do not understand that as a lender, we want to take your word, but we can't, because we have these government guidelines, especially from the crash of 2008. There's even more. So there's that. I'm looking for Chapter 13. Chapter 13, it's the same as FHA, 12 satisfactory payments plus a trustee approval if you're in the Chapter 13 bankruptcy. So you can be in the Chapter 13 and still get approved. Now, if it's post Chapter 13 and we are now 6 months later, you need to actually still provide the payment history for that. We don't need trustee approval because you've already been discharged. But we still need to get the payment history for that to show. We still need proof that you paid 12 months on time. So that's how that works. If you're over a year, then we don't even need to worry about it. Foreclosure, it's 2 years from the date of closing or the sheriff's sale. So if your home went into foreclosure, that's not the trigger for a start date for any program. Every single program is required based off of the sheriff's sale. So your home went to the county, and that deed got transferred. So in other words, it's going to go back to the lender, and then there's going to be this actual auction, and you can call it. It's typically called the sheriff's sale, and then that's where they sell the home. Hopefully, someone comes in and buys it then. Sometimes people don't buy it, and then what happens is it sits on there for 6 months, a year, 2 years. I've seen some even longer, and they haven't sold, and they're still in this window of, my 2 years hasn't started. So just keep that in mind as well. Deed in lieu, short sale, just think short sale, you sold your home for less, you paid the difference. And you voluntarily surrendered the property with that. Then what you'll have is a short sale, which is it's not actually showing on here like I want it to. Come on, where are you? Short sale complete on the facts. Voluntary surrender by the borrower payment history was not affected. It's voluntary communicating with the service holder. Then a waiting period from transfer date may not be necessary. So they're saying they may not have a time frame. So if the borrower's payment history on the property was not affected before the short sale, so if you were paying on time and voluntarily communicating with the servicer, then a waiting period from the date of transfer may not be necessary. That would be I need to relocate. I need to sell my home. And I'm going to go ahead and sell my home, and I unfortunately had to sell it for less because I had to move. My payments were on time. I'm just letting you know, Mr. and Mrs. Lender, that I have to move. And so this is what I sold it for, and I'm surrendering the property. So I'm doing a short sale with that. Then you may not have to actually wait. If it was on a VA guaranteed loan, then the borrower may not have full entitlement available for a new VA loan. Ensure that the borrower's COE or certificate of eligibility reflects sufficient entitlement to meet any secondary marketing requirements of the lender. There is an analysis that goes into your entitlement, and it's a calculation. I would have to relook it up, but that dictates how much you can qualify for. And that entitlement is based on the insurability of the loan. Okay. And that helps us to determine the amount that we get to use. So it depends on what your entitlement is. If you've had a VA loan before, your entitlement may not be the same. So that will depend. So not all loans, when people go to buy a home, are always 100% down. It's based on your entitlement in that calculation to determine how much you can qualify up to at 100%. And then anything over that, you would have to bring that additional cash to close. So if you want specific information on understanding what you qualify for, that falls into the lender's hands, and you would provide them with your certificate of eligibility. When they do your pre-approval and your analysis, they run it through underwriting, then they will let you know, hey, you are qualified up to, X amount at 100%. Anything above that, you're going to have to bring the difference down. All right, automated underwriting cases. Oh, just one quick thing. I would let the lender know, like, hey, here's my entitlement. Let me know what I can do up to 100% and what I can qualify up to with like 5 or 10% above my entitled amount. So that, because there's some lenders out there. So if you're just calling up a call center or something like that, so that type of scenario, then you may not get a more experienced loan officer who understands that, and they just structure up a $500,000 loan at 100%. And you may not qualify up to $500,000 at 100%. And then you go through this process. Let's say you put an offer on a home for $500,000, and you find out, oh, with my entitlement, I have to put down 10%. Oh, shoot. So you don't want to be in that position. Okay. Automated underwriting cases. Yep. So basically, whatever the automated underwriting system spits back, if it says approve eligible, most lenders, they're going to say you're good. Most banks, maybe. It depends on your situation and their overlays. So you typically want to find someone with less overlays, because you'll get to be able to get approved for more. You can do more. They're more lenient. Their process tends to be smoother, whereas someone with more overlays is more strict on what they're willing to lend to, and they have a smaller department tied to that. So the less they allow, the smaller that they have, the less they hire. So that means the process is typically a little bit slower, and they want to just lend what is considered A paper, or like top quality loans, which would be like, I'm doing a VA loan, but I'm putting down 25%. I just want to do the VA loan. And I have an 800 credit score. I have a 20% debt to income ratio. Sweet. Versus hey, I've got a 620 credit score. I've got a 53% debt to income ratio, and I'm doing 100% financing, so it's a very high risk loan. So it just depends on the situation. So typically, if you want to avoid a lot of hassle, you want to go to a lender with little to no overlays. Alimony child support. Look here, proof of deposit on bank statements for 3 months. Same. So 3 months of payments, and front page of details support that there's a 3-year continuance. 3 payments, 3-year continuance. So if you get child support, that's more common. I actually have not experienced anyone who's received alimony, only child support. But if you have someone who receives, if you receive child support and your child is 16, odds are we're not going to have that continuance. We'd have to get documentation that says that you can continue that through till they are 20 or 21 or through college or something like that. Something to say that it's going to continue beyond 18. Otherwise, it won't be counted. Okay. Employment gaps. Typically need explanation if it's greater than 30 days. So if it is accept approve, it says within 60 days. So generally it's 30, accept approve, it's within 60. And then if it's beyond 60, you definitely need an explanation for any gaps in employment. That's pretty standard for almost all the programs. And current employment for borrowers, yeah, that's just verification, nothing crazy. Digital tax return. So I already went over the documents. Generally what you need. If you want me to do an income podcast, I think that might not be bad. That'd be a good one. As far as what to look out for, what you need across all of the programs. So residual income is a VA criteria that a lot of people don't consider. So you have to pass this VA residual income test. So how to complete VA form, blah, 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 special instructions. So calculate maintenance and utility. So this is the first part about VA residual income is you have to count. So there's your debts that goes against your income. Then you have the maintenance and utility cost, which is 14 cents a square foot for the living area. Here's an example, 1,500 square foot home, unfinished basement. I have a combined maintenance and utility costs of $210 a month. So 1,500 times 0.14. There you go. For PUDs, include the monthly amount of maintenance as well. So you need your HOA due. Also inside of that calculation. So you have your maintenance fee, and then that with your debts will spit out. So once all of that, your debts are deducted from your income. So it's a deduction. Okay. So once all your debts are deducted and you have your maintenance fee deducted, you have your new housing payment deducted, then you have what's left of your income. And here's the table. So here's one if you're doing a loan amount of less than $79,999. If you're doing a loan amount above $80,000 or $80,000 or more, here's that guideline or these numbers where you need to be. So you have to pass this VA residual income test at $80 for each additional member up to a family of 7 if you're over 5. So that's one key thing as well, over 5, 75. Sweet. Moving on down, those are the main. I mean, most of these are very similar. Residual income. So we're good there. Oh, you can gross up Social Security and tax-free income. Use the current IRS and state tax income withholding or 125%, which is the same for FHA and USDA. So if you get, Social Security, you get child support. If you don't file taxes or you're in the lowest bracket, you're going to use probably the lowest bracket because I think it's above 125. If you don't file taxes, it's 125. So you just have to make sure you use a figure of 125 of the borrower's non-taxable income when grossing up. So it's IRS and state income tax withholding tables to determine an amount which can be potentially used and employed just by the actual income. So it depends. Either IRS tax bracket or 125. Scrolling on down. Most of this, that's an income ratio. Greater than 41% requires close scrutiny. So it just means they're going to have a more keen eye on it. So if we're over 41%, you're still fine. I would say it's more like if you're over 50, it gets a little touchy. If your residual income exceeds the guideline by at least 20%, then you're less scrutiny, right? So basically they're saying you have plenty of income. Ratio is greater than 41% unless it is larger due solely to the existence of tax-free income, which should be noted in the loan file. The loan may be approved with justification by the underwriter or supervisor. Again, I would say generally if you're doing a VA loan with 41%, you're not going to have any issues. Again, it's a case-by-case basis, so I should tread carefully with that. Compensating factors, excellent credit history, conservative use of consumer credit, minimal consumer credit, long-term employment, significant liquid assets, sizable down payment, existence of equity, little or no increase in shelter expense, military benefits, satisfactory home ownership experience, high residual income, all these things, low debt to income. Those help the file. They're going to help you with all files. All right, so that's it for that one. So if I went back here, I mean, that's the general of what I would really go over with VA personally. I'll just scrounge through this one more time just to see if there's anything else that might be good to go over. Refinancing, again, I mean, you can refinance up to 100%. I would just say that's more of like a case-by-case basis on what you can do. Again, I already went over the interest rate reduction loan. That's fine. Special requiring special underwriting. No, and again, I'm going over key areas here. I don't want to go over all these tiny ones. So you have to get a notice of value. So just to kind of go over, read notice of value from an appraisal standpoint. That can affect your value on your property. Let's see if they pop in a definition here. What do I use? So issuing the notice of value. When the fee appraiser uploads the completed appraisal report into, so it's the VA, there's a VA portal, web LGY. A lender's staff appraiser reviews, or VA staff must review the appraisal and issue a notice of value to the veteran. The NOV will inform the veteran about the results of the report and conditions that must be met for guarantee of the loan. So maybe they're subject to items, who knows? NOV explains how the appraisal reports differ from the home inspections and suggests that the veteran may wish to obtain a home inspection. The NOV reflects the results of the appraisal review. Lenders and servicers should refer to the NOV, not the appraisal, for the reasonable value. So if your NOV is lower, the lender's going to use the NOV because we have to refer to it for the reasonable value, not the appraisal. Okay? If the appraisal is less, we're using that one. So whichever's less is the one appraiser's using. Okay? So even if the NOV is higher, we could always dispute it if needed. So that's more of a refinance situation, certain purchases. But we could possibly bring that appraised value up, but ideally you want both of them to match. Otherwise, you're going to use the lesser of. So there's the NOV. So when you get out of that one, no real specifics from a property standpoint. I mean, if you see evidence of termites, you need a termite inspection. Most programs aren't going to want that. Well, and septic, water test. They want to have a map. That's going to be the general for it. Yeah, that's really about it. I don't think there's anything else that I would cover in here that's beyond the norm. Yeah, I can't see anything else. Okay. Yeah, so if you have any questions about VA loans, there's definitely, again, minor items that we could touch on. We'd be here all day if I went over everything. So this one's a little bit jumbled up, but I tried to cover, again, just the key areas that we typically see on a routine basis for VA loans. So if you're interested in a VA loan though, okay, it is one of the better loans that you can get out there. If you are a veteran and you have specific questions, there are a lot of case-by-case scenarios when it comes to VA loans. So from anything from your entitlements to your credit situation, but you will find a lot of similarities between VA and USDA and FHA loans. So any questions, feel free to drop them in the comments below. Feel free to reach out to any of my social media channels. Drop me a message. Would love to be able to go over any case-by-case basis with you, any specific questions. I think that helps more with VA loans and how their guidelines are set up with these different chapters. It's a lot easier to just answer or look into based on those and find those specific items. Again, otherwise we would be here literally all day. So thank you for tuning in, and I hope you have a wonderful day. Thank you for tuning in today to the Mortgage Guy Podcast. Make sure to follow me wherever you listen to your podcast on iTunes, Spotify, or my YouTube channel. And you can follow me as well on all social media platforms.